Operating cash flow can be defined as the cash flow generated by the normal business activities of the project. So again, if we have a project that is involve a shoe company getting into a line of children's shoes, the sales, the cost of making those, the salaries of the staff, that's what operating cash flow captures. What's the timing? At year zero, right, and that's right, right when the project starts, it's typically going to be zero. Something unusual might happen, but it's pretty atypical. The operating cash flow for year one, we assume to take place in 1 year. What that means is, suppose here we have time zero and here we have time one. We'd be selling shoes all year long and having costs all year long, but we're going to assume all of the operating cash flows takes place in 1 year. To having things take place at discrete points in time, and it's very common to assume it happens at the end of the period, it makes it easier for discounting, and as opposed to if everything happened evenly, it's hard to work with that. But if you assume it all happens at a discrete point, now you have something you can discount. Now you have something that all happens at the same time. So how it interacts with other things can all be taken into account. So for years one and later, operating cash flow can be negative, zero, or positive, because operating cash flow is really based on the performance of the line of business. It can be positive. We're selling lots and lots of shoes at a real healthy price. The costs are kept down, and we're generating operating cash flow. Could be negative. Could be that it's really hard to sell these, and costs are running out of control, and so operating cash flow is negative. And it could be zero if everything just matches up exactly. In general, with a project, you would expect, you would hope for operating cash flow to typically be positive, but for business reasons, sometimes, maybe it's slow getting started, or maybe you have a year where lots of costs that are relevant, come due, and it could be negative. So how are we going to compute operating cash flow? There's a number of different approaches. We are going to focus on one. Operating cash flow is net income plus depreciation. In a minute, we'll go through a net income statement, but net income is essentially the profits produced from business activities. And it's, as we'll see in a second, revenues minus cost minus depreciation. And depreciation is a non cash expense. So it influences net income. The larger depreciation is, the lower net income is. So depreciation has a negative effect on net income. However, as you can see, we add it back in because no cash comes out. So it affects net income negatively, but there's no cash, so we want to make sure to add it in. So net income plus depreciation. And again, what is depreciation? When you have capital spending, when a firm buys a fixed asset that's going to be productive over a long term, accounting rules say, even though you just spent 500,000 on that piece of equipment, you don't get to take it as an expense. Some or all of that, based on accounting rules, you get to take as an expense over a certain period of time, again, set by accounting rules. And so when those years come along, you get to take it as an expense, but there's no cash that went out of your pocket. The cash went out when you spent $500,000 on the piece of equipment. So it gets incorporated in your income statement, but it doesn't involve any cash at that point in time. So you want to add it back in. So the way our approach is going to work is we're going to focus on net income, and then we're going to focus on depreciation, and then we're going to add the two together when we kind of put it all together. So let's look at net income. So here is a net income statement of a project when we're doing project analysis. And again, we need to figure out net income so we can figure out operating cash flow, so we can get one of our 6 components and we can put all those together to get relevant cash flows for each year that we can discount, that we can then determine whether or not to do a project. So sales minus cost minus depreciation equals EBIT, which is earnings before interest and taxes. So let's subtract our interest, and it's always going to be equal to 0. Does not matter what's actually paid. A firm may borrow money in order to pursue a project. It may have to pay out interest. And it may be the case that with the project there's interest, without the project there's not. Does not matter. We ignore it. We want to separate out the financing decisions from the how we spend the money decision. And again, you can think of it as, suppose the borrowing decision was made separately and first, and we have the money. What's the best way to spend it? So EBIT is also equal to taxable income when we always assume interest is zero. So you figure out taxes and subtract those, taxes paid, and you get net income. And this is a basic income statement, a basic net income statement for a project. A couple of accounting notes. Sales, revenues, it's just the number of units sold times the average price per unit. Suppose we sell 1,000 units and the average price is $40, then revenues would be 40,000. Costs, there's two kinds of costs, fixed costs and variable costs. And sometimes costs are called total costs, expenses, or total expenses. And there's two components, fixed and variable. Variable changes with the number of units that are sold. So variable costs would just be the number of units sold times the average variable cost per unit. So suppose here we have 1,000 units, and suppose those are our, kid shoes that we sell for 40, and the leather needed for them costs $10. We'd have a variable cost of $10,000. If we only sold one pair of shoes, then the variable cost would be $10. Fixed costs, they don't change. It might be like the salary of someone that whether we sell 1,000 shoes or one shoe, they still get paid $50,000, and so it's a $50,000 expense. And you just can figure out the variable costs, fixed, add them up. We've already talked about depreciation. You get to take it for it's an expense that doesn't involve cash, and you get to spread it out over a certain period of time, and that's how it works. Even though you spend the money today, you get to take the expense over a certain period of time dictated by depreciation rules, and during that period of time the rules say how much you get to take each year. Taxes paid, we're going to assume a flat tax so that we have taxable income, which is going to be EBIT in our case, times the tax rate, which are going to be taxes paid. And again, taxes, corporate tax rate is the tax rate that we're going to be looking at. In some of the solutions, the step where EBIT minus 0 equals taxable income is excluded because no matter what's paid, interest is always 0. So once you get EBIT, which remember, sales minus costs minus depreciation, you have taxable income. You just multiply that by the tax rate and you can get taxes paid. Interesting note that when EBIT is negative, taxes paid are negative, which produces a positive cash flow. So suppose we have a situation where the taxable gain for our company's project is expected to be negative 50. Suppose taxes are 40%. We're saying taxes are negative 20. Taxes paid are negative 20. That doesn't mean, you might say, it's a negative. That means they pay 20. No, it means taxes paid is negative 20. Taxes paid are reduced by $20. And one way to think about it is suppose over here at another part of the firm, they made $50. They had a taxable income of 50. Well, 40% means that they would have to send a check for $20 off to the government. However, because of this loss, they offset each other, so the firm's total taxable gain, total taxable income is 0. Nothing goes, so because of the loss, taxes went from 20 to 0, save $20 in taxes, and that has a nice positive benefit. Net income and timing. At year 0, net income is typically 0. The project gets started, and that's what happens at year 0. Then over a full year, so you've got the first year, income is recorded, and then what happens in 1 year, that's where it gets recorded. So again, you're making sales and having costs all throughout the year, but it's not until the end of the year in one period at year 1 that net income is recorded. Again, that's consistent with what we talked about operating cash flow, where it takes place at the end of the year. So in 1 year, in 2 years, in 3 years. And again, net income can be negative, zero, or positive. It's positive if sales are relatively high, cost and depreciation is relatively low. Negative if you're not having big sales, but you do have big costs or big depreciation. And zero if everything just matches up exactly. So let's look at an example. We have Capital Drywall. They're looking to expand into Loudoun County. Here's our expectations for year 1, and we want to know what's the net income of the project. Sales of 420, costs of 185. Big project, they had to borrow, so in 1 year they're going to have to spend $50,000 on interest payments. Depreciation of 70,000, tax rate of 40%. So to find the net income, you get EBIT, which is earnings before interest and taxes. We'll subtract out interest. We'll subtract out taxes paid, and we'll have net income. Well, EBIT is just sales minus cost minus depreciation. 420 minus 185 minus 70 is 165. How about interest? Do we subtract out 50? No, interest is zero. Even though there really is a $50,000 check that will be written, we ignore it because we want to focus on the project independent of where the money came from. So therefore, taxable income is 165. Multiply it by 40%, and we pay $66,000 in taxes, or the firm pays $66,000 in taxes. So what's the net income? $99,000. How about year 2? Year 2, sales of 420, but big bonus to one of the managers, so they expect $385,000. $50,000 interest payment, depreciation of 70, taxes of 40. So what's taxable income? Sales minus cost minus depreciation. Sales of 420, costs of 385, and depreciation of 70. EBIT negative 35,000. Costs and depreciation are larger than sales, so therefore taxable income is negative. Interest is zero. So what are taxes paid? Taxes paid are equal to the $35,000 taxable loss. Net taxable income is negative 35 times 40 is negative 14. And again, it's tempting to say negative 35 and then I pay 14, so I'm at negative 49. But the net income is taxable income minus taxes paid, which are negative 14. So net income is negative 21,000. So again, think about it. We've got taxable, we've got a loss of 35. Over here in another part of the firm, let's say we have a gain, which means we have to pay 14 in taxes, but our loss cancels that out, so we don't have to pay the 14. We save 14. So we're out 35 from sales, cost, depreciation, etc. But we save 14, so we get back some of it with this, kind of this loss benefit, and we're at negative 21,000.